Excellent. So good morning, everybody, and thanks very much for taking the time to join this UHY Hacker Young and NatWest event this morning. Today's our follow-up to our Brexit event, which we ran in January. Over 300 of you joined us at that point, and clearly at that stage, we were looking at early feedback on the Brexit deal. Since then, clearly spring is approaching on us. The UK government's announced a roadmap out of the COVID restrictions. And I suppose most prevalent for our discussions today, we've got experience of the deal being implemented and what that practically means for both importers and exporters in the UK and the EU. So therefore, our discussion today is going to focus on three things. And firstly, we're going to have an update on ultimately what we know now on the topic of customs and VAT. And through a series of case studies and some insights by UHY Hacker Young, we're going to discuss that in some more detail. So to do so, once again, we're joined by Michelle Dale, Senior Manager at UHY Hacker Young. Michelle's a member of the CIOT and has had 17 years experience in industry, and on a day-to-day basis is responsible for general compliance, resolving disputes with HMRC and the VAT implications of international trade. We'll also be joined by Helen Cowley, tax partner. Helen's a chartered accountant and a tax advisor, and she specialises in international trade with over 20 years experience in accountancy and finance. The second topic we're going to cover off in a bit of detail today is freight. Now, clearly, supply chains and keeping a close eye on this has been a real key topic for businesses early in this year, and it's high on all customers' agendas. So to do that and get some more insight, we're going to hear from NatWest customer Edge Worldwide Logistics. We'll get some context on the industry and some insights into what's happening on the ground, both on a Brexit port disruption perspective and on the COVID impacted international trade and container issues. To do that, we're joined by Philip Edge. Philip's the CEO of EWL, or Edge Worldwide Logistics. And Philip graduated from the University of Manchester with a BA in International Business, Finance and Economics, and joined the firm in 2009. And clearly, with being a topic that he discusses every day with clients, we'll hopefully offer some real useful insights to those of you who have dialed in. And then finally, we're going to touch on the UK Export Finance General Export Facility. Clearly, last time we presented to you, there was a little bit of information available. That has increased since that point. And you may have noted in the press that that actually formed part of the British Airways funding package, which was announced last week. And to do that, we're going to hear from Simon Watson, Trade Director for NatWest in the north of England. Simon's day-to-day responsibilities are around helping customers with products and solutions to mitigate the risks of international trade, and he's got 30 years experience of doing so. And for our question and answer session, we'll be joined by Lynn Swerdlow, Relationship Director at NatWest, who's going to support with any questions on banking specifically. I think just before I hand over to our speakers, a couple of points of note. Please share your questions in the Q&A tab as we go along here. I think last time we had really valuable discussions from those. I think it's important to note that maybe some complexities and some specifics which aren't answerable in this forum, but we're very happy to pick up with those specifics after the event. And we've reserved at least 30 minutes of our 90-minute session today for question and answers. And I think finally from me, just by way of intro, I think I speak for all of our presenters today that would be delighted to follow up in more detail on any of the topics discussed. All of our contact details will be on the slides shared both now and after the event. So we're very happy to speak in more detail if there's a topic that you want some more support on to your business. So at this stage, that's all from me. I'll be back for the Q&A and I'll hand over to Helen, who's going to start to take us through initial feedback on that Brexit deal a few weeks on from our last discussions. So I'll hand over to Helen.
Thank you, Jonathan. Good morning, everyone, and thank you for joining us. So we are almost 2 months now past the end of the transitional period, and we've had opportunity, therefore, to see some of the issues faced by UK businesses. Hannah, can I have the contents page, please? Thank you. We're going to provide a very brief overview of some of the customs considerations. Mainly, this is around the rules of origin. If you were on our last webinar, you'll recall that Michelle spoke about those. It's an extremely specialist area, customs, and UHY consults with a customs specialist, Barbara Scott, who Michelle mentioned on the last webinar. Because we're looking at the impact on the supply chain, it will be remiss of us not to include some of the customs considerations, but it is going to be quite high level. The focus is going to be more on the VAT consequences of the EU-UK Trade and Cooperation Agreement. Michelle will cover in a fair amount of detail the VAT consequences of this agreement, including actual case studies on business to consumer and business to business transactions. I think it's fair to say that Michelle has lived and breathed Brexit since at least the beginning of this year, probably beforehand, and she has actually had opportunity to speak on the BBC News, so that was quite interesting and good for Michelle. So yeah, we'll cover off those case studies, and finally there's been a lot of talk around the Republic of Ireland and Northern Ireland. So Michelle's going to discuss the issues arising when sending goods to Northern Ireland and the interaction of those supplies with Southern Ireland. Can I have the next slide, please, Hannah? Thank you. Okay, so you will all be aware that the Trade and Cooperation Agreement was signed on the 24th of December of last year, so it didn't really give us much time considering the transitional period ended on the 31st of December. The main consideration has been around the rules of origin. The Trade and Cooperation Agreement doesn't cover everything, but this is the focus that we have. Now, the starting point is that duty will apply on goods traded between the UK and the EU unless the rules of origin apply. So these rules ensure that goods from third countries don't have the same benefits as those to the parties to the agreement. And broadly, the rules state that goods originating in the UK or the EU, so that could be goods manufactured here or in the EU, won't be subject to duty. Customs declarations will still be required though, and it's a two-part process, because if there's an import, say, into the UK, that means that there's an export from the EU, and therefore an import declaration will be needed and an export declaration, although there is a possibility that in due course just one declaration will be needed. So we've got the issue when we're looking at goods that are imported from say, China and subsequently exported to the EU without any significant processing, could result in a double duty implication. There's workarounds with this, such as bonded warehouses. Michelle's going to touch upon that briefly later on in the presentation. So I think the only other thing to mention here is the duty rates, the different. Obviously, the UK used to follow the EU duty rates, but since the 1st of January, the UK have been following the UK global tariff, and those rates can be found on the UK government website. Next slide, please, Hannah. Okay, so the rules of origin. So to qualify for the preferential treatment where no duty applies, the goods must be processed in the UK or the EU. There are rules that specifically exclude insufficient operations, so that includes the likes of repacking, labelling, and simple assembly of a product. So we have an issue where we've got, let's say, components coming in from third countries that make up a larger product. What we need to consider is, if those goods come into the UK and something's just being built that doesn't require specialist skills or machines, actually on the slides there it gives the definition of simple assembly. But if there isn't a substantial change to the product, then they probably won't be considered as originating in the UK or the EU. Different products have different rules. For example, for some products there must have been a change in the tariff heading. So when the imported materials come into the UK, materials or components come in under one tariff heading, and then those materials are processed in the UK and a product is produced which results in a different tariff heading, so it's going out on a different commodity code, then for some products, that is sufficient to meet the rules of origin. In other cases, the maximum value of the materials that are imported from a third country cannot exceed a certain percentage of the sales price of the finished product. Now, a typical example that we've heard being talked about are bicycle parts that are imported into the UK, and then the bicycle is produced in the UK. So assuming that process wasn't simple assembly of the parts, we then have to look at the value of the imported parts. So if the value of those imported parts in the example of a bicycle does not exceed 45% of the selling price of the bicycle, then the rules of origin should be met. Like I say, this is just an example. The rules are, of course, far more complex. I understand from the agreement that different products require different treatment. We do strongly recommend that you look at this on a product by product basis, and that you consult with a customs specialist. Like I say, UHY consults with customs specialists, and we'd be very pleased to put you in touch with Barbara if required. And now I would like to hand you over to Michelle, who is going to cover off in more detail the VAT consequences. Thank you.
Thank you, Helen. So what I'm looking to do today is give you guys an update on what has happened since the last webinar in early January. I apologise in advance. These slides are very wordy, but unfortunately there's no way around that. It's quite a wordy topic. So week 1, 4th of Jan, UHY, I was quiet. I was thinking, this is strange. I was answering emails that I didn't get around to answering last year. 5th of January, the chaos started. Week 1, some of the road services into the EU were stopped. The reason for that was because the information that was being supplied by the UK senders wasn't correct. So that was causing, when the carriers were trying to declare the goods and complete the import declarations, they were being bounced back from HMRC, which left a backup of goods. So many carriers chose to just stop the services temporarily while they tried to sort things out. Many overseas business customers, week 2, they said, that's it, we're no longer doing DAP terms anymore, which is delivered at place. And for those of you that don't know, delivered at place means that the customer in the country is responsible for clearing them goods into that country. And many overseas customers, they demanded DDP incoterms, DDP being delivered duty paid, making it the UK seller's responsibility to clear them goods into the EU country. There's been a lot of disgruntled EU customers who have bought on a business to customer basis from the UK, so they order goods from the UK. These have been delivered into the EU, but charges have been levied on them. And then the other side of that, we've had many UK individuals buying goods from the EU that have been charged import VAT and duty when the goods arrive, which they weren't expecting to pay. So when they bought their goods online, they didn't know that they were coming from France. And when the goods arrived, they was given import VAT and duty to pay before the goods would be delivered. And there's been confusion with the whole NI situation. And I've got a couple of slides on that. And there continues to be confusion there, to be honest. Next slide, please, Hannah. I just thought it'd be a good idea for me to pop this slide in. Not going to go into it in detail, but this just shows the information that is required on a commercial invoice, because this is where the errors are occurring, or they were occurring. I know businesses are getting to grips with it now and things are moving again. So the commercial invoice, this travels with the goods and it's needed for international shipping. It helps the customs authorities assess if any controls are required. So are health certificates needed, for example, for the plants, or import licenses needed for the product. And it helps determine what taxes are due. I just wanted to pay attention to point 6, and this is the one where it's caused issues because people haven't been describing their goods accurately. So an example of this would be, we can't just put clothing. We would have to put something like men's t-shirts, 80% cotton, 20% polyester. And if there's a brand on there, that would also need to be mentioned on the description as well. Next slide, please, Hannah. So moving on to my case study number 1. I thought I'm using case studies because these show you from start to finish how many businesses have been affected in the UK, and some workarounds that we've done by using the UHY International Network. So first of all, the very authentic name of ABC Limited. They sell clothing on a business to customer basis into the EU. So last year, ABC Limited would send the goods to their customers using the distance selling rules. So VAT would be charged at 20% unless they'd obviously exceeded the threshold in that country where they were selling to. And customers would place their order and the goods would be delivered within a couple of days. Fast forward to this year, ABC sends the goods, but they must be accompanied by the commercial invoice, as we've just said. No UK VAT is chargeable. The carrier completes the export declaration on behalf of the seller. The goods arrive in the country that they're going to, and import VAT and duty is charged to the customer. The import agent completes the declaration and charges the customer for this service. Next slide, Hannah. The customer gets a notification to say, hey, your goods have arrived, but you owe us X amount that we've had to pay to clear the goods into the country. The customer pays the charges and the goods are delivered. Goes without saying that there will definitely be an increase in delivery times there. So what happens next? And this is where I've been getting the calls. So we've either got the customer who pays the charges but complains to the UK seller because they haven't made them aware of these charges, or we've got the customer refuses to accept the parcel, sends it back to the UK, which causes issues for the sender because when the goods arrive back in the UK, they would be subject to import VAT and possibly duty when the goods arrive back. So can ABC continue to trade in the EU without these issues? And the answer to that is yes. They can register their UK business in an overseas country, in an EU country, as an overseas business. So you'll get an EORI number in that country, as well as your VAT number there. You would ship the goods via that EU country in which you've registered. So the distance selling regime would apply because that's still available to EU countries. Next slide, please, Hannah. And you would reclaim the import VAT charged in that country, and the customer gets their goods delivered without any charges. So basically, you register your UK entity as an overseas trader and continue to use the distance selling. Just a couple of important points, or the main one. This is only available till the 30th of June. From the 30th of June, the distance selling regime will be stopped and switched to the one-stop shop, and I'll come on to that separately shortly. I have included these two handsome guys here. These are the guys that work at Govers. I've been working with these guys on a daily basis. The Netherlands link seems to be very popular for doing these workarounds, and Anton and Martin have helped many of our clients to set up this structure.
Michelle, I know you're probably going to talk about fiscal representation later on in the presentation, but if a business registers for VAT in the Netherlands or another EU country, do they need fiscal representation, or can they just have a VAT agent?
It depends. There are some countries that don't require fiscal rep, but others do, and I've listed the ones that don't require fiscal rep later on in the slide pack.
Okay, thanks.
Thank you. Next slide, please, Hannah. So just a bit more detail on the one-stop shop. This is a simplification to facilitate the business-to-customer trade within the EU from the 1st of July this year. The UK business must register for VAT in an EU country to use this simplification. But if you think about it, if you are already doing the workaround, you've already got a VAT registration anywhere in another EU country. So you'll just literally switch from distance selling to one-stop shop. The one-stop shop returns are submitted every calendar quarter. The VAT is charged at the rate in the customer's location. So it's not the seller's location, it's literally determined on where your customer is based. For EU businesses that don't use the simplification, the alternative is registering for VAT in every EU country because the distance selling is being withdrawn. And for UK businesses that don't use the simplification, they have the option, do the customers pay the import charges, which is going to be a no-go because they basically won't buy from the UK seller, or the business register for VAT in each member country and the goods are shipped, delivered, duty paid, but that is an admin nightmare, having 27 registrations. Next slide, please, Hannah. Moving on to case study 2, this is looking at ABC Limited, again, selling shoes, but on a B2B basis this time. So business to business, with the customer being VAT registered in the EU. Last year, the goods were dispatched from the UK and they were zero rated intra-community supplies. No UK VAT chargeable, the customer accounted for requisition tax and the goods were shipped on a DAP basis. There were no charges or disruption to the customer whatsoever. Fast forward to this year, the goods are now being exported, so they must be accompanied by a commercial invoice, which is an increase in admin work. The transaction is zero rated for VAT purposes, and we have to remember that the export rules must be considered, so that is, the goods must be moved within the time limits and proof of export must be retained. The export declaration is required by the seller, which is an increase in cost. The import declaration is required by the customer if the goods are going DAP, as they were last year. Import duty is due on arrival if the rules of origin are not met. Next slide, please, Hannah. Import VAT is due when the goods arrive at their destination and is payable by the importer of record. I think it goes without saying that this process will take longer than it did previously. So how did the customers react to these new rules? Well, as I mentioned on the very first slide, the DAP incoterms were withdrawn and the EU customers are insisting on DDP incoterms. As a consequence of this, the transaction is taken onshore. So the seller, the UK seller, is now responsible for accounting for that transaction in that country. ABC Limited would be responsible for clearing them goods into the country and being the importer of record. So paying any charges due. In most cases, the customer has a requirement to register for VAT in that country because there's a domestic transaction there now, with the exception of France, Spain or Belgium, because the supply between ABC Limited and the end customer is reverse chargeable. The UK seller will be raising an invoice and charging VAT at the local rate to the customer. Next slide, please, Hannah. Is there a workaround to this? Yes, there is. Many of our UK clients have set up an entity in the EU. Again, Netherlands seems to be the key place for this. They register for VAT and get an EU EORI number there. They move stock there using third-party logistics businesses, or they can fulfill their orders directly from the UK, going via that country if needed. They transact the sale through the new overseas entity, and as a result, the transfer of the goods on, or the sale of the goods on to the end customer in the EU can revert back to DAP, and they are back to the treatment as they had previously prior to us leaving the EU, which is an inter-community transaction. So basically, the UK company moved their own goods to the BV in this instance, and the BV will have an intra-community transaction with the EU customer. So we're back to how it was last year. Done a little diagram there just to show how that would work. And I think it's a key point there is fiscal representation may be required to do this. Some of our clients, they didn't want to set up a BV or an entity in another country. So they've gone down the route of registering their UK business in that country, which also works well. But there's just France, Spain and Belgium, they can't do that because of the reverse charge. Next slide, please, Hannah. And there's some special schemes in some countries that this type of setup wouldn't be enabled to use. So like the Article 23 in the Netherlands, which is similar to the postponed VAT accounting, it wouldn't be available if you've no substance in that country. Are businesses doing this and is it working? Yes, it is working. Many businesses are doing it. Where the businesses, as I just mentioned then, where the businesses don't want to or can't fulfill their orders through using third-party logistics, they are just transferring the goods from the UK into the EU and doing an onward supply from there. Just wanted to point out here that it is early days yet, but the EU, my experience to date is that the EU tax authorities are working hard with UK businesses to enable the trade to continue.
So just, I think in our experience, Michelle, that it seems that many businesses are choosing to establish a separate entity rather than actually going for multiple registrations or registrations in the member states that they're dealing with. Even though there's probably more kind of reporting from an accounting and tax, direct tax perspective.
Yeah, so I think, well, what's definitely happening is where the EU business, the EU trade is going to be serviced by an EU business setup, whether that be an actual entity in that country or an overseas registration there. And the UK will continue to source the UK trade and maybe the exports that they initially had anyway. So if you've got a business that's always used to exporting, that will continue to go through the UK entity.
Yeah, thanks.
Next slide, please, Hannah. Here's the quick list of countries that don't require fiscal representation. You can have a read through this in your own time, but I just thought I'd put it in. It just explains what fiscal representation is. And I just wanted to add that we've got many clients that are using Dasukla. I've put the name on there, then you can have a look. It seemed very cost competitive. And they are a platform-based facility, and they use a portal for managing the fiscal rep information. But in most countries, you can't operate from a VAT or customer's perspective without this. So I think it's something that if you're considering taking some trade abroad, it has to be considered.
I think it's worth pointing out as well that you've mentioned there that the fiscal representation can be costly, but that's because the representative is taking on joint and several liability for the VAT liability within that territory.
And customs.
And customs as well.
Yeah.
Yeah, so that just puts it into some sort of context as to why it costs.
Yeah. Next slide, please, Hannah. Moving on to the good stuff. Trouble with the Irish. I say this completely tongue-in-cheek, by the way, because we've been working great with our guys in Ireland. What's happened? Well, the majority of Irish businesses, as with all the other EU countries, have refused to trade with the UK on a DAP basis. So what does this mean for our UK sellers that have always traded with ROI for many years? It means that they've been forced to ship DDP, taking the transaction on shore. And as a result of that, they are now required to be VAT registered in the Republic of Ireland as an overseas business. Fiscal representation is required. Import VAT is accounted for when the goods arrive, and import duty where applicable. The import VAT, there is a similar system to the postponed VAT accounting. I think in Ireland it's referred to as deferred VAT accounting. And the transaction, because it's being taken on shore, it's a domestic supply, so the UK entities are now raising sales invoices to their customers in the Republic of Ireland, charging the rate of VAT in Ireland, which is currently 21%, and I believe goes up to 23% on the 1st of May. An EU EORI is required for these transactions. Next slide, please, Hannah. This guy here, Niall, I think he's absolutely sick to death of my emails. We've had so many of our clients being having to register over there, and the team at FWD have been great and helped us out. I just want to point out that if we've got any businesses that are considering going down this route or have to go down this route, the Irish tax authorities are taking a little bit longer than usual to process these registrations due to the significant increase of businesses that need to register there. One final thing I just wanted to mention, it's come from a pre-submitted question, was, and Helen mentioned it earlier, was about the double duty. So we seem to be having this a lot with the goods going to the Republic of Ireland. So an example of this is goods coming into the UK from China and then onwards supply to our long established customer in the Republic of Ireland for 10 years. Because when the goods come in, there's import duty on them. When we move them on to the Republic of Ireland, import duty at the same rate is also due when them goods arrive in that country. So if this is something that's affecting your business, you need to be looking at one of the customs procedures to try and help with this. Whether it be coming into a bonded warehouse, which effectively suspends the goods from coming into free circulation in the UK and almost moves the border straight from China to the Republic of Ireland, or whether if the goods are coming into the UK to undergo, as Helen mentioned, some sort of process, whether we go down the inward process and relief route. But there are customs procedures that can be looked at to help with this. Next slide, please, Hannah. Moving on to the north. It's complicated, and I'm sure anybody that's sending goods to the north will agree with me. Just put some key points on here. Must-dos. Any business that is in Northern Ireland or trading with Northern Ireland on a goods basis must get an XIEORI number and register with the Trader Support Service. Couple of scenarios for you here, where we've got goods moving from GB to NI and the goods are going to stay in NI. This is a UK to UK transaction. UK VAT charged at 20%. VAT invoice is required as always. The supplier and the customer both need the XIEORI numbers. There is no duty payable. There is no export declaration here, but there needs to be, on arrival, somebody to be the declarant for these goods. So if you're a UK supplier, you could do with trying to push this onto your customer in NI. Whether or not they'll go for it is another matter. Moving on to goods that may go into the Republic of Ireland. So where we've got goods going from GB to NI with the possibility of them going over the border. These goods are deemed at risk. So we've got UK VAT chargeable at the appropriate rate. We've got import duty payable where the rules of origin are not met. So the Trader Support Service that I mentioned they can help reclaim this duty if the goods don't end up going to Republic of Ireland. The XIEORI numbers are required, and I'm told that a transit guarantee may be required when moving the goods from the north into the south. When I mentioned then import duties payable when the rules of origin are not met, when I was speaking to Barbara yesterday, the customs consultant that we used, she told me that as of yesterday, no import duty has been paid at all in the north of Ireland yet because the systems are not up and running, and that's expected to start this week. So maybe if things have happened and you've moved goods, at-risk goods during the first 6 weeks of the year and haven't had an import duty charge, this is the reason why, and maybe when the things start kicking in, this may then become an issue for you guys if you're moving at-risk goods.
Sorry, Michelle, what does at-risk mean? Is that at risk of potentially being sent to the Republic of Ireland?
Yeah, so an example, so one of our clients, they are DIY hardware and they sell to a wholesaler in the north of Ireland, they wholesale DIY hardware, a sort of B&Q setup, and when they bring their goods in, all of their goods are at risk because a big proportion of their customers actually come from the south to buy from them. So a large proportion of them goods will actually go to the south. So when they're moving all their goods now into Ireland, all of their goods are deemed at risk. So moving on to my last slide, please, Hannah. So as of this week, what's the latest? Businesses are getting to grips with the information that they require for their import and export declarations. Goods are moving now, albeit a little bit slow. HMRC, because we've had so many overseas businesses wanting to register in the UK because of the change in trading terms, HMRC are currently taking 15 weeks to process any VAT registrations for overseas businesses. We have had an update this morning on that, and they're saying that they're going to try and process 95% of all VAT registrations within 30 days by the end of March. And we'll believe that when we see it, maybe. The rules of origin, they continue to be an issue. Although I'm not sure that they are causing issues, but I'm not sure that some businesses are actually taking this as seriously as what they should. Because of the relaxed approach for supplier declarations and evidence, many businesses, I think, are just brushing this under the carpet for now and thinking we'll deal with it when the government start cracking down on us. So I'm not sure if this may be an issue early in next year, because I think we've got a 12-month grace period for this. And the trade with Ireland is still difficult, but we are working on it and things do seem to be going. So we're all heading in the right direction, which is very positive, because I don't think nothing's going to change. The rules are in place now, so we just have to learn to work with the rules. And then last slide, please, Hannah. Just our ugly mugs, mine and Helen's. If you've got any questions, obviously do get in touch or get them in the Q&A box at the bottom, and we'll try and go through them in the time at the end. If not, and it's more specialised, we can pick it up offline. That's not an issue. That's me done. And I will now pass over to Philip from Edge Worldwide Logistics, and he will tell you all about what's been happening actually on the ground. Thanks, Philip.
Thanks, Michelle. Good morning, everyone. So I'm just going to cover a couple of things off today. So one of them is going to be specifically around the EU trade, and the other is going to be a more general look at what is a struggling international supply chain scenario that we're facing at the moment. So Hannah, if you want to go on to the first slide, please. So just a very quick overview of our business. We concentrate on three areas, which is sea, air and road. About 70% of our business is sea, 15% air and 15% road. We're one of the largest privately owned freight forwarding businesses within the UK. We do about 100,000 customs entries a year. We have a dedicated team. We cover every port, whether that's road ports or truck ports, as you probably know them as, or container ports. Everything in the UK we cover. We've got partnerships all over the world, including every country in the EU. Very proud of an award-winning business. So we've been in the Sunday Times International Track 200 for 3 of the last 6 years. And one of the big changing factors for our business and for the wider freight forwarding community and supply chain management community at the moment is the introduction of disruptive technology. You probably see it yourselves with the likes of DPD and Hermes and the couriers, where you get your maps and you see where things are going, and you can get to change where items are going to, or left with a neighbour, or whatever it may be. And we're seeing similar kind of things starting to disrupt our industry. So I'll talk about that a little bit as well, and how it can help reduce the administrative burden that you may be having, particularly with shipments to and from the EU. If you go on to the next slide, please, Hannah. So again, quite a wordy slide, but there's a reasonable amount to cover here. Firstly, it sounds very, very obvious, but we're not in the EU anymore. The UK is now a third country. So what happened prior to the 1st of January simply is not happening anymore. So, you know, the workarounds, these kind of things that we may be looking at, yes, there's opportunities there, but if we all take a step back from what's going on and think to ourselves, well, if we're sending stuff to the EU, we might as well be sending things to America or China or Australia. And if that's the attitude we take towards our documentation specifically, then it can really help that flow of transportation in and out of the EU. So at the moment, what are we seeing in the marketplace? Well, volumes are low. Many businesses, as we know, stockpiled significantly prior to Brexit to avoid potential customs issues, potential duty issues. But we're starting to see an uptick in volume occurring at the moment, and we think that sort of normalised volumes will start to get back probably April to May time. So now is really the chance and the opportunity to get everything right in terms of documentation, particularly any company setups, which Michelle and Helen touched upon before, to ensure that your goods move smoothly between the UK and the EU. Many of the ports are different from main container ports. There's been lots in the press and the news around congestion, particularly Felixstowe and Southampton, but most of the ports that we use for the trucks are different ports. They're not quite as badly impacted as those main container ports, but there is still congestion there. At the moment, because of low volumes and issues with customs, particularly, I think a lot of these are teething issues, many truckers still aren't calling in the UK, which means lack of availability and higher prices. And one of the other big hurdles that we're seeing at the moment, particularly on exports from the UK into the EU, is the requirement for drivers to get COVID tests and the added layer of complexity that adds, which means, again, so many truckers just don't want to go through that and don't want to call in the UK. One of the most important things at the moment is having documentation correct. If documents are correct, goods will flow freely. It's quite simple. But what we are seeing a lot of, and particularly with potential new customers and things that we're seeing, is simply that goods are leaving factories, goods are leaving warehouses, people aren't checking documentation and thinking that they can get to the port and somehow magically things can travel through and get customs cleared. And the reality is that just doesn't happen. So what's really important is before anything leaves at all that is coming into the UK or is going from the UK into the EU, it's so important that documents are checked. There's technology there that can help assist with this, where whether it's a supplier you've got in the EU or yourselves, you can upload documents onto these onto the technology systems, and people can check them for you, make sure that they're correct before things go, and even extract information on that document to auto-populate customs software, which can do your customs clearances, so you have a free flow of goods that are moving in and out of the UK. I saw a question actually before from Jonathan, and I thought it was probably a good opportunity to answer that question. So rules of origin, I mean, this is a really major issue. I mean, one of the things is on a commercial invoice, there has to be a statement of origin on that commercial invoice. That is what the customs authorities look at when goods are moving in and out of the UK. But very simply, because the UK is a third country, the example was that if you have a manufacturer in Italy who manufactures, I think it was computing systems, you bring those goods into the UK and then you send them on to Ireland. Well, if your UK warehouse isn't bonded, then those goods have come into the UK, they've been customs cleared in the UK, and now they're not of UK origin. So it doesn't matter that they've come from Italy to begin with, they're not a UK origin, they go into Ireland and they have to be customs. So customs duties will apply to those goods when they hit the Irish border. The way around this is bonded warehousing. So bonded warehousing, I don't think has been such a hot topic ever, certainly when I've been in business. So what a bonded warehouse allows you to do, it allows you effectively to hold goods in transit. So if you're bringing products in from, whether it's non-EU or EU countries, and you're bringing them into the UK and redistributing them to your EU customers, if you have a bonded warehouse, it's effectively only transiting through the UK. So you do a simplified entry, it comes into your bonded warehouse, and then you take it. And then if you bought it from China, as an example, you will not pay duty into the bonded warehouse. You'll only pay duty once, and that's when it hits the border of the EU country that you're sending it into. So what would happen if you didn't have a bonded warehouse is you're importing some widgets from China, as an example. The widgets would come in, you would pay duty on them when they came to the UK. They would then lose their origin status. You would then send them from the UK into the EU, and you would have to pay duty on them again. The only way around that is through bonded warehousing. So that's why I wanted to touch upon it. I put a little mention there of free ports. There's lots and lots of talk about this, and I think it's something that's going to move on with speed. So lots of countries around the world that you go to, you know, an example I always use because I have an office over there is Thailand. Thailand has a huge free port that sits around its main seaport, Lam Shabang, and it's a manufacturing hub for, you know, particularly the automobile and construction sectors. So I think more than 20 airports and ports have put applications into the government for free ports, and what that will effectively allow is factories and warehouses to be sat in these free port areas, and again, effectively, those goods never enter the UK. So if you want to have, you know, if you're doing fulfillment for people, you want to be packing and labeling things and sending things to you, it's like they've never really entered into the UK. So that's a zone where the normal rules in effect don't apply. Next point is from the 1st of April, there's new rules coming in as well. One of our really big areas of the business is food and drink. And at the moment, we're still using the same health certificates as we were before, but the new UK certification on health comes into force on the 1st of April. So that's, again, is a big change. So anyone who's doing food and drink, or, you know, anyone who's importing products that require health certificates, so any products that contain meats, an example, some products that contain dairy as well, fish, or whether it be pet food, whatever it may be, then this is something you really need to start looking at with your freight and customs provider. A couple of other points to finish off this slide. So if you can, if you're moving things around, be reliant on yourself and be reliant on your own systems. Try, if you can, where possible, to move full loads, so you're not reliant on other people, so you don't have 3 or 4 other people's pallets that are going on the same trucks as you have, and you're reliant on them doing the customs properly, because it is a very expensive process. If things get delayed at ports, drivers are delayed, trucks are delayed, waiting time gets charged, it can be quite an expensive process, and it can also be quite difficult to sort out if documentation isn't correct by the time drivers have arrived at ports, particularly if they've already gone to overseas countries. One of the things we speak a lot with customers about is try and look at intermodal options more. So by intermodal, I mean rail and short sea. So the benefit of doing that, if your products are in trucks and they come in and there's any issues at customs or delays at the border, you very quickly you'll have to start paying waiting time, which I touched upon before. So, but if you can look, particularly this applies to Mediterranean countries, so things that come out of Spain, Portugal, Italy, Greece, these areas, there's lots and lots of short sea options, intermodal options that can bring goods in. Often, you know, the lead times are long, but often they're significantly cheaper than bringing these items in by trucks. That's something to really look at going forward. My last point really is technology is becoming vital. I touched on this before, document sharing. So we have a system ourselves that's called Connect, and what we can do within that is we can take uploads from our customers, whether it's your EU suppliers, if it's you manufacturing products and supplying them yourselves, the POs are uploaded into our system. Everyone in the chain can share information. The PO details are matched to the commercial invoices and matched to any other documents that are required to meet the customs criteria, being the UK customs or EU customs. And we can read data from the information from that, and also information from those documents, to actually create customs clearances themselves and auto upload them. So that removes a big layer of administration from yourself, but also your freight providers that you may be using. Your next slide, please, Hannah. So moving on from the UK, EU trade to the international container trade. I was asked to speak about this morning because it is, you know, it's quite a hot topic at the moment, and you know, pretty much because we're coming off what has been record-breaking freight rates. I'd like to make this a bit more good news, but the news actually is not great. I'll specifically focus on Asia because that's where around 70% of the global container trade involves Asia. So if I really look at that and give you a bit of background to what's happened. So when COVID impacted, the way COVID happened, we first beginning in Asia and then moving into Europe and the USA and Western countries, it created a real perfect storm, because the supply chain lives in a harmony as long as things flow. And when those flows stop, very, very quickly bottlenecks are created. So what happened was, when after Chinese factories closed, there was vessels and vessels full of goods that were on the way into Europe and the USA specifically. And at the time that the Chinese factories shut and China really closed the business, and these vessels arrived into Europe and the USA, that's at the time our lockdowns really begun to happen. So there was tens of thousands of containers that were arriving into the UK, into Northern Europe, into the USA, that just didn't have a home because people's warehouses had closed, people didn't really know what to do with them. And very, very quickly they clogged up ports. And at the same time, because there was no business coming from Asia, a lot of the shipping lines just simply stopped sailing the vessels. So all of a sudden you had a huge glut of containers that was clogging up the ports in the UK, in Europe, in the USA, Australia. There's lots of countries this was happening in at the time. And that's really the start of it. And we've never, since that point, we've never caught up because we had the biggest slump in global demand that's ever happened, and followed by the biggest rise in global demand straight off the back of it that's ever happened. And the pressure that then came on the supply chain was just enormous. So it really broke the chain. And this has led to the demand far outstripping the supply because huge stockpiling, start that again. So these huge levels of stockpiling were then required because all of a sudden the switch was turned back on with the demand. Everything that was on the floor, everything that was arrived in the UK, as an example, was very, very quickly cleared, very quickly delivered into warehouses. And then all these items were sold to the public. So there was a huge demand for requirement for imports, specifically from China and the Far East. So the level of imports at the moment that's coming into the UK ports is about 30% higher than it was a year before. So it's at historically high levels. And a lot of the shipping lines are cut capacity because they didn't think they had the demand there. This capacity has again come back online, and we've seen that we're pretty much at full capacity now, bar maybe 5%, which will probably come back in the market with April, May time with a couple of new vessels. And demand is still far, far outstripping supply. So what happens in these circumstances? Shipping rates skyrocket. So we have seen I think from the trough to the peak of last year, we saw about 1,000% increase in the price of containers going from Asia into Europe. And even though Chinese New Year has given a little bit of respite of that, we're still seeing after Chinese New Year, demand is still at record high levels. So, and there's a big backlog still where people have not managed to restock. So there's still a big backlog coming from factories and warehouses, particularly in China and Southeast Asia. And added to that as well, the fuel price, you will see oil prices have gone up, but fuel prices have increased 70% since November for shipping fuel. Again, that's going to feed through into prices if it's not done already. So if we go specifically into the UK issues that we're facing at the moment, so when all these containers arrived, and then they were finally delivered to the end users in the warehouses, so April, May, June time, they've gone back to the ports. There's simply so many of them there compared to the capacity that's available in the market with shipping lines to take them back, that a lot of these empty containers are still today sat at the ports of Southampton and Felix. So, and what this means is that a lot of congestion is happening. So it's so much more difficult when ports are full and ports are operating capacity to move things around the ports, because every time you need to make a move of one container, there's so many more others that you need to move to get into the stacks, to get the containers out that you require. So the productivity of the ports greatly reduces. And to be very honest, the ports were probably creaking even before this happened. And you're also very reliant on the infrastructure that's around those ports. So the rail infrastructure, there's lots and lots of talk about HS2. I mean, that's a real hot topic at the moment. And a lot of people condemn HS2 because, saying, well, okay, it adds a bit more passenger capacity and it's 20, 30 minutes faster into London. But one of the big things that people don't really talk about is actually the requirement for rail of freight. So it will add something between 30 and 40% capacity to the rail market for freight, which is desperately needed. We also have a lot of truckers that aren't moving containers around anymore because of the boom in online shopping. Many of these truckers who are working 60, 70 hours a week moving containers around don't really want to do it anymore. So what they're actually doing is if going to work for your Amazons, your DPDs, these kind of people, and they're having a bit of an easier life than what they would have done delivering containers around. So there's a shortage of drivers. So it's very difficult, even when products arrives at the ports, to get these moved from the port to the warehouses. For UK exporters, again, it's not a great picture. So with the lack of empties that we're seeing, particularly in Asia, and the build-up of empty containers in Europe, and again in the USA, it's a huge problem, then lots and lots of shipping lines are prioritising taking empty containers back to Asia, where they can utilise and earn the most revenue taking those containers then to the USA or bringing them back to Europe, rather than taking them laden. Because the issue when you take a laden container is that it takes up weight on the vessel, but also upon arrival, it might take 2 to 3 weeks for these containers to customs cleared, delivered, and get back into the pool that the container lines can then use. There's a real lack of alternative options. The world of shipping is an oligopoly in effect. So there's 3 main alliances, an example that you can use from Asia into Europe. There's not many alternatives that even when you look at air freight. I mean, air freight is not operating anywhere near the capacity it was doing before, and that's simply because people aren't flying around the world. At the end of the day, over 50% of air freight flies on passenger aircraft, and when those passenger aircraft aren't flying, then there's a huge lack of capacity in the air freight market, and prices spike. So what we've seen in the container industry has also been reflected in the air industry. And we don't expect that to change until people get moving around the world and intercontinental travel gets going and back to the levels that it was pre the COVID crisis. I mean, one ray of light that I could possibly give you is the UK is bad, but the USA is actually much, much worse. The port of Long Beach, which is California, which is just outside Los Angeles, is probably the worst impacted port in the world. At any one time, there's probably 20 ships that are sat off the port, and many of them have been there for 2 to 3 weeks just waiting to get into the port of Long Beach. And even when containers are arriving at Long Beach, it can take up to 1 month just to get put it through the port and get people to come and collect them. So a lot of people are asking me, what's normal now? What should I be putting into my prices? Well, where we were before, if we go back to November, December 2019, the levels of the container levels that we saw then, pricing levels, it's going to be a long, long time, if ever, in my opinion, that rates will go back to that level, because what shipping lines have shown is during this crisis, they have a very good ability to manage the market and a very good ability to keep rates high, and they work together in effect to do this. So when you're pricing for this year, as an example, on a longer term basis, we've got lots of people onto us saying, well, I'm just waiting for the rates to come down. And the rates will come down from $10,000 plus levels that they were. And there's no doubt about that. But we're talking months rather than weeks. So it's really trying to plan around that. And ultimately, the freight levels that we'll probably see on Asia to Europe, and even on Europe to Asia as well, are probably going to be 2 to 3 times higher than what we've seen historically. And I think that's going to be the case for certainly the next year or so. So when you're planning your costings and things, that's something really to bear in mind. Next slide, please, Hannah. So just a little bit in terms of technology and what's available there at the moment, what you should really be speaking to your suppliers around. So all these items that I'm talking here, so you can see here, so shipments approval, purchase order visibility, delivery planners. So that transaction you've often done via email, maybe with your freight forwarders and transport providers. You should now be able to really start looking at technological tools to do that. Document cloud, AI reading of documents, EDI links. So we're seeing more and more to this technology being applied across the marketplace, which is really reducing administration levels of what is required. So when you're making emails to booking, rather than sending these emails and you're waiting on people to come back to you, is going on to diaries and planners and making those delivery bookings online. Everyone in your chain, from your suppliers all the way to yourselves and anyone else that you want to have viewpoints of it, can have a purchase order visibility of exactly what's moving at any one time, where those products are, what the purchase order numbers are. You should be able to approve shipments online. You should be able to approve documents, upload documents online. That's your vendors and yourselves. So this again is really, really helpful in terms of that friction that we're seeing between the UK and the EU, just having that ability for your suppliers to put your document, your commercial invoice, your packing list online, for having someone to be able to check that and ensure they're right before any goods move is a really, really powerful tool. And also to be able to read and auto-upload all that information into the customs portal to automate the customs entries is something that we're seeing huge demand for at the moment, and have those EDI links where the technology is automatically updating you as the client and your customers as well in terms of what's happening with those orders. And that's it from me, really. I think that's all my slides. So yeah, there's a quick thank you. If you want to get in touch, there's my email address, and there's the email address of our sales team as well. And again, if anyone wants to call, there's our phone number as well. But I really appreciate your time today, and I will now pass on to Simon from NatWest.
Thank you, Philip. So I think all of the topics that, obviously move on to me. I think so. I think all of the topics that I've covered so far also reverberate into our world. Essentially, we're sort of seeing all of those topics around double duty, bonded warehousing, and the increase in freight rates really having a major impact on our clients. If we just move on to the next slide, we spoke last time in terms of updating you around the general export facility. Before I do move on to that, though, as I say, we have been seeing those other topics impacting our clients. So freight costs, particularly, we've been seeing people looking to us to support funding around those. And we also talked last time around the benefits that HMRC were providing in terms of the movement from a working capital perspective of postponing import VAT and paying VAT at the time of sale. And also whereby clients could apply for a duty guarantee waiver, which enabled them to remove facilities. So we've seen those things happening within that last few weeks, and I think there's still the ability for people to further benefit from those changes. So as I say, we said we would talk a little bit more about where the banks are gaining support from the UK government to support exporters. Now, I'll sort of show how I think this may wrap into the topic of Brexit as we go as well. I had a quick look at when the government export credit guarantee department actually formed, and that was strangely enough in 1919. And it was there to promote UK exports following the port blockages from submarines around our waters from World War I. So we sort of see some similarities in terms of the difficulties moving goods through ports. ECGD sort of lost some of its assistance really through the late 80s into the 90s for SMEs. And ECGD focused on helping companies export more around the upper end, so the likes of Rolls-Royce and British Aerospace and companies like that. And then when the financial crisis hit, it was really felt that UK exporters would certainly benefit if they could gain some assistance, and that would really help with our balance of payments and the like. So UKEF was set up under the banner of ECGD, and quite a few people were employed to promote what could be done to help exporters. And indeed, it was a really useful, but sort of around 2008 onwards time, it was a really useful tool to help banks help exporters. But the problem that we found, was around. It was a contract by contract specific process, and it was a little bit difficult to get through that process quite quickly, to get finance out to clients, working capital and guarantee support. So what was launched in the last few weeks was the General Export Facility under the UKEF banner, and that really opens it up to more of a mass market there, but in more ways than just directly linked to exports. So how's this changed really, and what does it do? Well, what it does is it means that where a bank's approach to offer working capital support or guarantee support, if the bank particularly feels that it's worth supporting that business and right to support the business, but in terms of security or balance sheet strength, the bank is struggling to assist, then we can turn to UKEF to sort of bridge that gap of security, and we can look to obtain maybe up to 80% support, and that can really open up the ability to support businesses. Now, how this has changed particularly is that it's not contract by contract specific anymore. One of the basic criteria is that a business needs to be able to evidence that it turns over or has turned over in the last 3 years 5% of its turnover is for export. So if a business wants to find some support, even if it's in terms of R&D support, if that can be evidence that essentially that R&D will help improve exports, then we can look to help in that manner. But equally, if people are importing products and that product is destined for the UK market, then again it can be looked at. So it's very much simpler and more varied for UK businesses. It also means that we're not looking at specific contract by contract transactions. So rather than the bigger transactions we've looked at previously and supported, businesses that have many transactions, perhaps some goods are coming into the UK and maybe re-exported, but that some of those goods are for the UK market, it means we can wrap it into a working capital facility, a trade loan that may well assist with financing that. So it's a very brief slide there to sort of show that what we've now got is a pretty flexible solution that we can turn to in terms of government support, and we can get to a much bigger market than we previously could. And we can chat to clients afterwards if they feel that they need further support. And particularly, we've seen great support in terms of the civil schemes, etc. As those perhaps will come to an end, we've also got another scheme here, which is not dissimilar in some respects in terms of that government support that we can benefit from. So that was just a short update in terms of what additional funding can be possibly achieved. So I'm going to sort of hand it back to Jonathan now, just to wrap up, and you've got our contact details there.
Well, thank you, Simon, Philip, Michelle and Helen. Thanks very much for the content of those presentations. Really appreciated. We wanted to get through as many of your questions as we possibly could do now before we close at 12:30. So I'll fire straight into those, and our panel will happily jump in and do so. So maybe, Michelle, if I could start with yourself. There was a question that's coming from John, and it's going back to your Dutch entity question on or case study that you shared with us. And John's question is, back on that case study too, do goods have to physically move from ABC Limited to ABC BV before going to the end customer? Was a question that John has asked on there.
Yeah, they would have to. So the goods would have to go through the country that you're going to VAT register in. So what we've seen is a lot of the carriers are now creating a service for this. So when the goods leave the UK, you'll package up all of your B2C supplies. So if you've got 1,000 orders, they will go pre-packaged with the addresses on. So they will go to the Netherlands, they will be cleared in there and then on to your customers. So there'd be no fulfillment due in that country because everything will have been done on the UK side of things.
Brill, thank you very much. With a question, we were discussing the Irish question, obviously in a bit of detail there. Someone's asked the question: who determines that your products are at risk? Is that a decision for the business to take, or otherwise?
It's whoever's going to be the declarant, basically. Whoever's going to declare the goods, they make the decision. And obviously, if they make the wrong decision, I would imagine at some point down the line there may be some implications on that. But if you know that them goods could potentially end up in the Republic of Ireland, then you should be paying the duty on them when you can pay the duty in Northern Ireland, which is not yet.
Absolutely. Brill, thank you. Helen, I know you answered a question that someone asked about, but I thought it was just worth sharing just with the wider group, because I think it's a question maybe with not a specific answer, but worth discussing. But Shai asked, from a work from home perspective, what has changed for European nationals working for a UK company out of Europe? And there's not necessarily a consistent answer on this one, is there?
No, I mean, I hate to use the phrase "it depends," but it really just depends. I did say that I would pick up offline, actually, just to get specific details, because it very much depends on whether or not that presumably the EU national has been working for the UK company and did do before the end of the transition period. They're well, they're not immigrations, it's more a social security contribution point and income tax. Now, it will probably remain the same, whereby either the UK company is registered in the EU member state for social security contributions and pays employer and employees contributions there. It's the most likely answer, but I am going to pick up offline as well.
Brill, thank you. That's really appreciated. And there's a question that's come through later, I think, while you were discussing, Philip, and maybe one for you and the UHY team to talk on, but just touch on inward processing, which is an anonymous question, but which the question maker has asked. I understand there's a suspension of tax and duty on goods that just require processing here. We have goods coming in from China already cleared in the UK, VAT and excise is paid. We now need to move to France to complete the product and then import it back to us to the UK. How do we avoid a double hit?
Yeah, I mean, I'm happy to put that out. It's actually more outward processing that that's discussing. So the way to avoid that is, if you're bringing the goods in from China, is take them into a bonded warehouse in the UK. I mean, the things that are already here, unfortunately, the way you pay VAT and excise, VAT and duties, not that much you can do about it. But when you take it to France, you can apply for outward processing relief, which basically allows full or partial duty relief when the goods come back in, even though they're going to, they lose their origin status, that third country thing that we were talking about before. So that's what you really need to look at, is trying to ensure that when you bring the goods in from China, they're going into a bonded warehouse, you send them to France to be completed, and there has to be, whether it's a repair or there's got to be a significant change in that good to apply for to get the processing relief. When you come back, you'll get the relief on the duty.
Can I just add to that as well? When the goods arrive in France, they could do with going under some customs procedure there, or otherwise they may be subject to the local taxes when the goods arrive there. So the French version of inward processing relief.
Yeah.
Brilliant. Thank you, that's really appreciated. And Philip, can I just stay on the topic of bonded warehouse, just from for those people that may be new to from discussions today, just from an admin perspective, and Simon, you might come in here afterwards as well, how easy or onerous is that to set up and administer going forwards, Philip?
Yeah, I mean, it's not that easy to set up. I mean, obviously a lot of people are doing it at the moment. It's a process you have to go through HMRC, and it's basically checking the security of the premises. It's checking the robustness of your processes as well, in terms of how your inventory, how you look after your inventory going in and out. But once it's done, and as long as it's applying technology to things that are leaving your warehouse specifically, so you can do your declarations. But once it's done and set up, it's relatively straightforward to keep on top of. But if you've not had one before, it's quite a significant change going from not having one to having one, because the way you import your goods does change. So rather than paying all the duty and VAT if you're importing containers at the ports of entry in Southampton, Felixstowe as an example, you're now moving those under a simplified process. You take them into your warehouse, and you're only paying as those goods are leaving the warehouse, or again, if they're going back in transit to another country, you don't pay it at all. One of the things it does obviously save upon is, and help with, and Simon might be able to touch a bit more upon this, is it does assist with your cash flow, because you're not paying that duty at the point of entry.
Yeah, exactly that. You're postponing that duty, if it ever needs to be paid at all, because you might be bringing some goods out which is coming into the UK market where duty would need to be paid, and indeed some may then be going out and duty not needing to be paid because it's not staying in the UK. So yeah, working capital can be affected, particularly if you're holding sort of large amounts of stock for long periods. That is definitely an advantage. Philip touched upon technology earlier. I think that's probably one of the key things in terms of the bonded warehouse nature, really. You can either use a third-party warehouse, of course, but if you're using your own, then it's a question of making sure you've really gone through and probably employed some specialists to help you out to get a virtual bonded warehouse system in place to be able to use the technology to handle a lot of that admin.
Real, thanks, Simon. That's appreciated. And Michelle, one I know you went back to, it was a comment from an attendee, but just maybe worth briefly discussing. But Jackie talked about the fact that, obviously you raised that people are increasingly being forced to ship DDP.
Yeah.
She's still successfully managing to do DAP terms to Europe and Northern Ireland, but clearly this is a customer by customer discussion point, isn't it, as you work through these?
It is, and I think because clients are only coming to me when they've got a problem, the ones that I'm not hearing from, I'm presuming are still DAP is still fine. But we've had an awful lot. Well, all the ones that I've dealt with, apart from one customer for one client, where DAP is still acceptable trading incoterms.
Understood. Thank you very much. A question that's just coming from Arvin. So their business is already registered with various countries in the EU for VAT returns. Can you please confirm what happens when our couriers are clearing goods in the Netherlands and then transport to France? We are being charged an import VAT, and then we also have the distance sales VAT in France. How do we claim the import VAT back from the Netherlands, as this is not the final destination?
Right, let me just have a read. So we have got, I'm presuming we've got B2C. So we have got business to customer, and we are being charged VAT, import VAT. Then we also have the distance sales VAT in France. Maybe I'll pick that one up offline. Only because what I'm looking at there is we've obviously got the movement of goods business to customer. So we would, if we've already got VAT registrations in France, Spain and Germany and Italy, is that because you've exceeded the distance selling thresholds in that country? If so, we can no longer, we can continue to, oh gosh, let's take it up offline, because it's obviously if we're moving goods if they're all going in through the Netherlands and we're moving on, we have got transactions where we should be charging Dutch VAT, but I'm not sure we would still require all the EU VAT registrations. So I'll come back to you on that either later today, Arvin, or tomorrow.
Thanks, Michelle. And probably just brings to life the complexities of some of these questions. There's one.
That's a bit like a chartered tax exam question from 2011.
Well,
so yeah, I'll pick it up later.
We've got confidence in you in delivering a top level answer on that one in due course. And there might be one similar here from Paul, looking back just before 11:45 if you're looking through the Q&As. But he's got a business that's looking to set up an Irish company to enable trade in Ireland, much like some of the stuff we've discussed. His questions lie around, operation after that point from a financial point of view. How can they charge management fees between UK and Irish company and getting out excess profits? This maybe want to pick up separately as we go.
That's one for our Helen. That is definitely not me, thank God.
Quite pleased to see this come up actually, because this is an area I specialise in, which is corporation tax and international trade and investments. I think I'm going to answer the question briefly, just very broadly for the benefit of the audience, but I've made a note of this particular one to pick up with Paul offline, because I need a few more of these details as to the setup of the holding company and the subsidiary and the operations and any agreements in place. But broadly, what he's asking here is, we've got an Irish subsidiary, can we charge management fees? Yes, you can. I presume you mean from the UK parent company to the Irish subsidiary. Depending on the size of your group, you may have to follow transfer pricing regulations on a mandatory basis. And that basically looks at justifying the management fee. So you look at what would you charge to an independent third party? It's called the arm's length basis. Now, that is often a way that people get profits out of another country. I would like to pick up with you, Paul, as to the rationale for doing that, because currently Ireland has a lower rate of corporation tax to the UK, so it may be more beneficial to keep profits in Ireland. But when you have a subsidiary that's paying a low tax rate, then we have other things to think about as well. anti-avoidance legislation in the UK, basically. So it's really, really complex. It's even more complex than the exam question Michelle got. But I'd be delighted to speak to you about it in more detail. And we can speak also about various ways to get post-tax profits, basically the dividends. We consider any withholding tax implications, and whether it's best to structure things a little bit differently, but I'd need to understand how the subsidiary is funded. So I'm sorry I can't give a specific answer on that. And point 3, I definitely have to defer on that because that's not corporation tax. I don't know if I'm trying to find the question now. There's a lot of questions. We want to drop ship from the UK company on behalf of the Irish entity. Is duty payable on the shipping element of the cost? And can we ship direct to the Irish customer? Now, Phil, I don't know if that's something that you can answer or whether or not it's something that we pick up separately with our customs specialist.
I think it's probably best to look at, the customs specialist. I think there's a thing where, particularly with VAT, where a lot of people are charging it onwards to the people that are importing it into the country. But again, it's definitely that's definitely best to check, I think.
Yeah. Okay. That's great. So yeah, I'll probably be tomorrow now, Paul. If that's okay, I'll drop you an email and can discuss in further detail.
Brill, thank you very much. Can I just touch on another country of origin, rules of origin question that's come in from Phil most recently. So if goods are imported from the EU and then exported back to the EU, do goods lose preference upon import to the UK, or do they retain EU origin or export? Goods are only warehoused in the UK, no processing. Maybe it comes back to our customs warehouse discussions, but Michelle or Philip, any views on that one?
Sorry, I'm just reading the question again.
Yeah.
So they're coming in from the EU to be warehoused, then going back. So when the goods, do they lose their preference upon? So when the goods, I'm going to presume that when the goods arrive from the EU, the rules of origin are met. So there's no duty. So when the goods go back,
They do.
They do. Yeah, they do. They lose it.
Again, it goes back to the bonded warehousing side.
I was going to say that. Yeah.
If you bring a product from France into the UK, and so it's a French origin, you bring it into the UK, it doesn't go under bond, and you send that same product to Ireland, Spain, Holland, wherever it may be, then it loses its origin status. You will have to, you have to pay whatever it is.
If you have a considerable amount of this, you would possibly look to do a third-party logistics. Maybe if it's purely for warehousing and no processing, you'd look for a third-party logistics in another EU country and cut all that out.
Absolutely. That's one of the things that we're seeing a lot more of is people taking things directly into Europe. Particularly, one of the really big areas because about access to the German and French markets, obviously the Benelux region as well, is there's lots and lots of these kind of places around in and around Rotterdam. A lot of them got very good systems. They can do, whether it's pallet loads through to e-fulfillment. There's some really, really good operators in that region, and they're very, very used to doing it. One of the questions we get asked a lot about is Amazon. Lots of people selling to Amazon, sending things into Amazon FBA warehousing, and the view we get from Amazon is they're not interested at all in taking any responsibility for the duties, VAT, and it's purely down to yourself. And I think the people that are moving a lot of those goods, particularly into your Amazons of this world, they are taking advantage and they are setting up those facilities in the Netherlands.
Well, thanks very much. Simon, I've got a question for you on the General Export Scheme in 1 second, but Michelle, there's a question just coming from Elizabeth. You might have a quick glance over on One Stop Shop whilst I'm asking Simon. That one will maybe come to that one in a second. So Simon, customers ask, we import raw materials from Europe and export finished goods worldwide. If I need a funding facility to help with that supply chain and raw material funding, can I ask my bank about the GEF scheme? I'm assuming that meets our criteria in that one.
Yeah, so if somebody exports or has exported 5% of the turnover in the last 3 years as export, then That's one of the criteria. Or if they're fairly new and they've done 20% in any 1 year in the last 3 years, then that's again one of the criteria that opens that discussion up. What I would say is, I mean, banks should be looking to see if they can support the customers directly themselves first. But this is a great scheme where we could also turn to where we feel we need further support. But yeah, I think it's exactly that now, that it doesn't have to be contract by contract specific. So I think that probably is one that he could bring to his bank and open that discussion.
Brill. Thank you, Sam. That's appreciated. So, Michelle, Elizabeth asked about the one-stop shop and forward-looking, and will that change requirement to register for VAT in other EU countries if this business wants to take care of the VAT? Is that one you can discuss at all?
Yeah. So if we've got a UK business that does business to customer sale of goods, they would have to register for VAT in another country. So whether it's through an Irish business or whether it's through an overseas, a foreign trader, as they call it in Ireland, they should be able to service that. That would be able to service that requirement.
Perfect. Thank you very much. We've got a couple of questions on online sales that have come through a variety of points today. So Kirsty's most recently asked, if we're selling goods online internationally B2C, should these all be 0 rated now, or is there a transition period? Our advice has been different. Can you clarify? And I think we had an earlier question about that transition period as well. So have you got any views on that from a reporting VAT perspective?
Yeah, there is no transition period, not that I'm aware of. So when you've got the sale of goods now going to the EU, all of them are now 0 rated exports. So the issue that you've got is when they arrive in the country that they're going to, then they will be subject to the local taxes, so import VAT at the rate in that country, plus the duty where applicable. So when your customer, they'll get a notification from the carrier to say, we've got your goods, we've paid these charges. I mean, to be honest, there has been some goods slipping through, I think, especially the lower values. We've had some clients where some customers are getting charges and others aren't. But I think the rates are up to €150, it's just import VAT. Over €150, there is import VAT and duty. But your type of business, Kirsty, that would be one that would be, the one-stop shop would be perfect for you guys come 1st of July.
Well, thank you, Michelle. I'm conscious of time. Probably got time for one more question. Just in terms of Steve's just asked, we'll be sharing the slides. We absolutely will. Straight after the call, we'll get those sent out to attendees, and obviously contact details on there if you need to discuss anything in a bit more detail. So probably the final one we can cover then is from Nish. So are there any advantages or disadvantages of having a branch office instead of a proper subsidiary or new entity set up in an EU country? And they ship EU to EU at the minute. Have you got any views on that one, Michelle, at all?
Can I give that one to you, Helen? Branch versus subsidiary.
I was just trying to unmute them, Michelle. It wouldn't let me. Yes, this is more not from a VAT perspective. It's more from a direct tax perspective, which is corporation tax. There are lots of different pros and cons of branch versus subsidiary. One of the things that people consider initially is whether or not there are going to be any startup losses. Because if there are, those losses of the branch will form part of your UK taxable profits. So they'll reduce your UK taxable profits and you get immediate tax relief on those. On the flip side, if you have a separate entity, then those losses can only be carried forward for offset against future profits of that trade of the entity, of the subsidiary. That's one of the major things that people consider. And I know we don't like to think about losses, but they can happen in startup, and you've got to think of the cash flow advantage to obtaining a tax saving there or a tax refund. There are other things, legal considerations, commercial considerations. So from a legal viewpoint, the branch will simply be an extension of your UK company. And therefore, you need to consider the exposure to any potential litigation overseas. So sometimes people prefer, depending on what type of business you do, people prefer to ring fence that risk by setting up a separate legal entity. There are lots of other points, and again, I'd be pleased to actually drop you an email and just have a discussion around what it is that you're thinking of doing, particularly because, you know, I've given a whole presentation previously on branch versus subsidiary and the different tax, commercial, legal considerations. So I can't answer the question fully with 1 minute to go, but I'd be really pleased to chat further.
Brill. Look, thank you very much, everyone, for your engagement on the questions. Thank you to our panel, so Michelle and Helen, for their expertise and exam standard answers, and we've tested them on. We'll definitely look through those if there's any we've missed and follow up with you. And I know we've referenced a couple of specifics that we want to follow up with, obviously, and in light of the questions asked today, which we'll do so. I don't know if you want to jump in there, Michelle.
Can I just add there, Jonathan? There's a couple that have come in from anonymous when I've just looked up the list. So obviously I won't have your email details to come back to you on the Q&A. So if you want to just, my email details are on my slides. If you want to just drop me an email, then I can come back to you. That would be great.
Thank you, Michelle. That's great. So thanks to UHY Hacker Young. Philip, thank you very much from an Edge Worldwide Logistics perspective. Really interesting insights into the shipping market. And Simon and Lynn, thanks very much from a NatWest perspective for providing those bits of overview. We appreciate your time today. We'll get the slide contents out to you. And as I said, very happy to follow up in specifics on any of the topics discussed from any of our panel. We'll leave you to your afternoons. Thanks for your time, and we'll speak to you soon.